Hello and welcome to the tutorial Basics of Technical Analysis. Before going into the world of technical analysis, you need to have an idea of how things work. Hence this tutorial where you will learn what are charts, how to interpret charts, you'll have an idea of how market moves, how it moves in an uneven way and uneven direction, and you will also learn about moving averages and how important they are in understanding supports and resistance. Moving ahead, I'll walk you through the contents of technical analysis. First chapter is Introduction. In this chapter, you will learn about technical analysis and need for technical analysis, how technical analysis differs from fundamental analysis. The next chapter, you learn about qualities of a technical analyst, how an ideal technical analyst works. Next chapter is on charts and price bars. This is where technical analysis starts. This is where you will learn how actually to use your charts and how to interpret them for finding direction. So you learn about charts, what are price bars, and how to interpret them. Next chapter is on volume. Volume is a very small data, yet it's quite a crucial one. It will help you understand the strength of a price move. Our fourth chapter is on supports and resistance. If you are familiar with stock market, you will always know you'll always find your friends or colleagues speaking that it has come to a point like an ABC stock has crossed 15,000 mark. Now it won't stop until 20,000 mark. So that 15,000 and 20,000, that becomes a crucial level for that ABC stock. That is what you will learn in your fourth chapter about supports and resistance. What kind of supports and resistance are there and how to identify them. Our fifth chapter takes support and resistance to the next level. And in this chapter, you will learn about trending and non-trending market, what is a trend, and how to identify trending and non-trending market. Next chapter is dynamic support and resistance. Basically, this chapter will tell you about moving averages and their most commonly used settings. You will also see how moving averages go so well in finding support and resistance, or how stocks respect moving average levels. And finally, we will conclude our current tutorial. Let's start with our first chapter, Introduction to Technical Analysis. Technical analysis can be used for stocks, forex, commodities, and index futures. Once you learn technical analysis, you can apply it on any script or any trading instrument traded on any exchange in the world. Alright? It can be applied to any trading instrument traded on any exchange in the world. Now, why there is a need for technical analysis? We'll have a small argument between technical analysis and fundamental analysis. In today's dynamic world, reaction of price depend on a lot of fundamental factors. Fundamental factors differ for different scripts. We'll take an example of cotton and a banking stock. Fundamental factors for cotton are climate change, governmental regulations and policies, drought, or any kind of natural disaster. So fundamental factors that will determine price of cotton are climate change, regulations, or some natural disasters. Whereas these fundamental factors won't affect a banking stock. Fundamental factors that will affect price change of a banking stocks are completely different. So what affects price change of a banking stock? Maybe quarterly earnings, its business model, RBI policies, or global financial moves, any kind of important global development. Hence, fundamental factors for each stocks are different. Any two different trading instrument won't have same fundamental factors. It is not possible to keep an eye on every change in fundamental factors. Sometimes the news is shared with general public long after the impact is done on market. Even if we did come across an important piece of news or an important development in fundamentals of a given stock, it's hard to judge the kind of reaction the market will give to that news, to that fundamental development. As a result, fundamental factors, even if we are aware of an important development, it's very hard to make a subjective decision or a subjective judgment. Hence, it becomes necessary to have a reliable medium through which any person can make decisions consistently. You need to have a reliable medium through which you can make consistent decisions. Hence comes technical analysis. Technical analysis is an art of speculating a price behavior through its past actions. Technical analysis does not consider fundamental factors. It deals with price actions and volume traded on markets. Let's go ahead and take a look at some of the qualities of a technical analyst. One of the most basic quality of a technical analyst is he depends on technical analysis and he may not depend on fundamentals for his decision making. A technical analyst mostly or basically depends on price and volume data and derivatives of price and volume, for example, indicators for his decision making. He may not depend on fundamentals. Even if he uses fundamentals, the scope of fundamentals will be limited or very basic. A technical analyst depends on price patterns to identify it and exploit it. He depends on reliable price patterns that keep on repeating in the market. He looks for repetitive price patterns in stocks, and once he is fully satisfied about the reliability of price patterns, then he looks to trade it. He looks for repetitive price patterns, patterns that repeat themselves in each and every stock in any market conditions. He looks for such reliable patterns, and then once he is satisfied, he looks to trade them. A technical analyst may or may not have predefined price targets, but he always have a predefined stop loss. A technical analyst may not have a target how high a stock might go or how low a stock might fall, but he always have a stop loss. What if the pattern doesn't turns out the way he is thinking? What if the pattern gets void? Hence, in such situations, he keeps a stop loss. He uses a stop loss just in case the pattern gets void. An important note, work with stop loss. Remember, this is one of the most basic quality of a technical analyst. Use stop losses, work with stop loss. As you will be working with probabilities and not certainties, you need to have a stop loss. Now, a stop loss or a price stop loss, your trading capital stop loss can be either percentage of your trading capital or a part of your trading capital. If you're using a percentage stop loss, it can be 1% or 2% of your trading capital. For example, you're not willing to risk more than 1% of your trading capital on any given trade. Let's take an example. If you have 1 lakh rupees, you may not be willing to risk more than 1/10 of your trading capital on a given trade. So 1/10 part of 1 lakh comes to 10,000. You may not be willing to risk more than 10,000 on any particular trade. So that becomes a part of your trading capital. You can work with anything, either percentage, you can risk a percentage of your trading capital or a part of your trading capital. But what is more important is you must always work with a stop loss. Let's have a small note on market tips. Market tips are floating all around you. You will find them through your friends, you'll find them on the internet, you'll find them with your banker, everyone, everywhere. They will have a, one or the other very important market tips for you. Now, never trade on market tips, no matter how reliable the source. Even if the person who is handing over the tip is your best friend, still do not trade on market tips. You will always find good reasons backing up tips, but the validity of such reasons is still questionable. A technical analyst depends on his own reasons and judgment to select a trade. Alright? A technical analyst depends on himself to select a trade. He may not depend on market tips. He conducts the trade on his own accord rather than depending on some market tips. Hence, remember, the reliability of market tips is highly questionable, hence never trade on market tips. Next important quality of a technical analyst is backtesting. Backtesting is one of the most important quality of a technical analyst. If you as an analyst have found a setup that you believe can be traded on markets, then you must backtest that idea thoroughly before taking it live into markets. If you have an idea, if you have seen a pattern into charts, if you have seen a setup or a pattern that is repeating itself on various different charts, and if you think that they can be exploited for profits, you need to go back into the history of that traded instrument or of any traded instrument. You need to go back into its history and see if that idea has worked there too. You need to test your idea on various instruments in different market conditions. Hence, you need to go back into the history of those traded instruments and test your idea. See if your idea has worked in the past too. Use charts to see past traded history of a script and backtest your idea thoroughly. This will help you see the shortcomings of that idea and how it performs in various market conditions. It will help you get a feeling about your own ideas, whether they have worked well under different market conditions, how they have performed in stagnated market conditions, and how they have performed in volatile market conditions. You will have a feel about your own ideas. Hence, it is very much important that you thoroughly backtest your idea on a wide range of data covering different aspects of market. Backtesting is your third eye as a technical analyst. Hence, remember to backtest your idea thoroughly. Spend hours and hours on backtesting. This will help you get a feel about your own idea. Let's go ahead and learn about price wars. A price war represents a trading day. Any instrument that is traded on the market, the important factors or the important actions that took place on that day for that instrument are recorded into a price war. All important piece of information that a technical analyst needs for decision making is included into a price war. A price war consists information about open, its high, its low, and its close. Open, high, low, and close are four most important factors of any trading instrument. Let's see how a price war looks like. This is how a price war looks like. The black figure surrounded by red arrows. This is your price war. A price bar consists of a high, the top of the bar, a low, bottom of the bar, open, a horizontal line to the left hand side, and close, a small horizontal line to the right hand side. So this is how a price bar looks like. Let's go ahead. In most of charting softwares, you will find green colored and red colored price bars, or in many you will find blue colored and red colored price bars. These colors help you interpret the price actions more easily. It will help you know what happened to that stock on that particular day visually. Basically, a green colored price bar means that market closed above its open. So no matter where the price is opened, the close was above its open, whereas a red colored bar will indicate that market closed below its open. Any trading instrument, if it has a red colored price bar, it means the close was below its open in the early part of the day. A green colored price bar, its close was above its open in the early part of the day. Okay, when the market closed, the close was above its open. Here, when the market closed, the close was below its open. Let's go ahead and take a look at actual chart. Now this is how a chart looks like. If you're not already familiar with the chart, this is how a chart looks like, and these are the price bar. Each and every single price bar represents a single trading day. For example, this green colored price bar represents 13th of October. Similarly, this green colored bar will represent 10th of November. Now, these gray colored lines that divide these price bars into groups. These gray colored lines are basically consist 1 week. So this is 1 week, and this is 1 week, this is 1 week, this is 1 week, 1 week, and so on. So a 1 week set of data. So price bars are divided into weeks. Let's go ahead, and you can see arrows pointing out red colored price bars. Take a close look at these bars. To the left hand side horizontal line is your open for the day. Right hand side horizontal line is your close for the day. And you can see that the stock closed below its open. It had a negative close, hence a red colored bar. Similarly, take a look at this bar, green colored. It opened at 860, whereas it closed very close to 885. So the close was above its open, hence a green colored bar. Similarly, all these green colored bar are basically days where close was above its open, and all these red colored bar are basically days where close was below its open. What does the price bar say? Each price bar will give you some important data about how trading went for that particular stock for a given day. Here is a basic example or a basic idea. A long price bar suggests that there was lot of activity into market. Okay, a long green colored bar will suggest that market went higher. Market had quite a substantial move towards the upside. Similarly, a wrong red colored bar will tell you that market fell down quite hard. A small red colored bar will tell you there was not much activity into market for the day. A small green colored bar will also suggest you that there's not much activity into the market for the day, but still it's green colored because close was slightly above the open. Similarly, it's red colored because close was slightly below the open. So along with giving you the factors like open, high, low, close, a bar also tells you whether the move, whether the day, trading day was significant or not. It gives you an idea if there was interest into the market or not. Let's go back to our example. Here, look at this green colored bar. a long green colored bar. This tells you there was a lot of activity went through the trading day and market was pushed. In this banking stock, HDFC Bank stock was pushed higher with a strong close, which means there was quite a lot of strength in the market. Now look at this red colored bar. Although it has wide range, what does this suggest? It suggests that market opened near 895, it went higher till 910, but it could not sustain the level of 910 and was pushed down and closed slightly, very slightly below 895. Similarly, look at this bar, red colored bar. Market opened at its previous close, went higher, it made a new high. You can see the red colored high is slightly higher than previous green colored bar. Then it simply shot down. It was traded downwards, but there was some buying interest as a result. After making a low, market recovered a bit and closed near 920. So every single bar gives you some of the important data to help you interpret what happened to that particular stock on that trading day. Look at this bar, a small negative bar. This tells you that even though prices closed negative, there was not much interest shown in that stock on that particular day. Similarly, a small green colored bar, not much interest shown. Whereas, look at this green colored bar, an upside surging strong green colored bar, telling you that there is a lot of activity going into the market. Hence, a price bar, along with giving you open, high, low, and close data, it also tells you whether the activity was significant or not. Let's go ahead and learn about volume. Volume is number of contracts traded for the day for that particular script. If volume for the day is 50,000, then it should be interpreted that 50,000 shares changed hands for the day. Volume can help understand significance of any price move. A price move with higher volume indicates that there is greater interest of people in the stock. It will also help you understand that the price move is genuine as it is backed up by high volumes, whereas a price move with lower volumes indicate there is not much interest into stocks. Or it will also warn you that the significant price move might be artificially generated. Let's go ahead. This is a price chart of Heidelberg, and below this is the section for volume. You can see there are red colored lines in between. These red colored lines indicate highest volume for previous 5 days. So this is highest volume in its previous 5 day of volume. In previous 5 day of volume, this one was highest volume, this one was highest volume as compared to its previous 5 day of volume, and so on. So this is how volume is plotted as a histogram. Here the volumes are calculated in millions, 1 million, 2 million, and 3 million, and so on. So this is how a volume looks like, plotted as a histogram. Now, as I said earlier, volume helps you understand the significance of a price move. You can see in number 1, an upside price move is supported by an increasing set of volume. When prices started to retrace back or consolidated, the volume got substantially decreased, suggesting the fact that people are not interested to sell their stocks as of yet. When prices started to move up again, you can see volumes steadily increased. This suggests that people started to acquire fresh lot of stocks again. When prices hit a new high of 105 and fell down, as prices started falling down, you can see volume decreased drastically. Volume almost dried up. Even though price fell a lot, almost 15% from if we took a high of 100, prices fell almost 15%, but there was not significant volume. This suggested that people are yet not ready to sell out of this stock. So, when prices are retracing or consolidating, volume have completely dried off. Now you can see how important volume is in understanding a significance of any price move. A significant price move with good volume indicates that the move is authentic, whereas a significant price move on thin volume may indicate that the price move is artificially created and its validity is questionable. You can take an example of this price move. Price fell down quickly, but there was not increasing volume, rather there was decreasing volume, suggesting the fact that this downside price move is questionable or the trend has yet not changed. Hence, price move backed up with good volume are authentic. Price move backed up with thin volume may be questionable. Let's go ahead and learn about support and resistance. Support and resistance are prices from which stock price often change the direction. A falling stock price may find support at its previous highs or its previous lows. Similarly, a rising stock price may find resistance at its previous highs. Price support and resistance, whereas the other one is pattern support and resistance. Many a times, prices find support at important levels like 100, 150, 1000, etc. Thus, price levels where prices find support are called price supports, and levels where prices find resistance are called price resistance. Mostly, these are whole numbers or important numbers like 100, maybe 500, or important psychological numbers where if you are aware of Sensex, BSE index, you will see that one Sensex had a psychological resistance of 20,000. People talked whether it will be able to cross 20,000 and sustain itself above 20,000. So these numbers are psychological numbers. A newly listed stock at 20 rupees may rise higher and find difficult to penetrate the level of 50, and so on. We'll take an example. Following is an NBCC chart. It covers data from July 2014 to November 2014. Starting from July, you can see the stock surged higher but failed to penetrate the level of 500. It fell down, found support at the level of 400, started rising higher. Over a period of a month, it drifted sideways and then fell down, but found support at 400, reacted, went up, started drifting again, and then it started surging slowly towards the upside. Finally, it penetrated the resistance of 500. Once penetrated, you can see 500 started acting as a support. So the resistance turned into a support. You can see it went up, came down, tested the level of 500, then went up to 550, came down again, failed to penetrate 500, and then finally it broke out to a new high, surged up to 750, came down, found support at 650, went up to level of 750 again, consolidated for a week, finally it broke out to a new high and surged as high as 900 before finding resistance at 900, from where it started drifting below. As 750 has acted as a resistance, chances are from here on this stock might find 750 as a support. So once a resistance is penetrated, it starts acting as a support. Similarly, if a support is broken, it might start acting as a resistance. Now let's go ahead and learn about pattern support and resistance. Prices of any trading instrument tends to move in a wave-like structure, thus making price patterns. These price patterns often make peaks and valleys. These peaks and valleys later act as support or resistance for future price changes. Many a times, prices find difficulties to break through these and change direction, whereas many a times, prices break the psychological barrier and make significant price moves. Just like they find barriers at price levels, similarly, many a times they find barriers at pattern levels. Hence, it is important for a technical analyst to be aware of these price patterns and their levels. Let's take an example. This is a chart of National Aluminium covering data from June 2014 to November 2014. Starting from the left hand side, you can see that stocks went as high as 62, reacted from there, but found support just above the level of 50. From here, they changed their direction. For the month of June, it drifted from 50 to 62, made a new high at 62. In the month of July, it failed to sustain the high of 62, came falling down, but found support at its previous low of 50, found support and then changed its direction, went high as 62, but found support at its top, previous pattern top, and then it started drifting sideways for half part of August. In the later half part, it fell down, but found support at its previous pattern level of 52. In the month of September, it changed its direction, broke its previous double top level of 63 and went higher to make a new high at 68. Came down, went up, broke the level of 68 but failed to sustain it and came crashing down. In the first week of October, it came as low as 54 but found support at its previous pattern low and changed its direction and drifted sideways for the most part of October. And as of November, it's still drifting sideways. So it is important to be aware of pattern levels to identify support and resistance zones. Let's learn about trends. Market always tends to move in a zigzag motion. They never move in a steady motion. These zigzag motion give rise to wave-like structure. We can take help of these wave structures to speculate if stock is moving in upward direction or downward direction, or whether it's moving sideways. Following are different types of trend: an uptrend, a downtrend, a sideways, or non-trending market, or a no trend. Let's go ahead. What is an uptrend? A stock is said to be moving upwards or is in uptrend if it has rising tops and rising bottoms. Thus it makes a rising wave-like structure. Take a book and draw a rising zigzag pattern. You will see that is how an uptrending market exactly looks like. An uptrend looks something like this. Market is said to be moving in an uptrend if it has a series of upward moving waves or upward moving patterns. It has rising tops, tops that are higher than the previous tops. At the same time, it has rising bottom or bottoms that are higher than the previous bottoms. An uptrend has a series of rising tops and rising bottoms. This is a real chart example of Lupin. It covers data from May 2014 to November 2014. In the early part of June, it started moving, surging upwards, took out its previous top, made a new top, came down, then went ahead to take out its previous top, thus giving us a new top and a new bottom. Similarly, went up, came down, and then took out its previous top, thus giving us new top and new bottom. It continued to go, made a new high, came down, and then went ahead to take out its own top to reach 1500, thus giving us new top and new bottom. Now compare these bottoms and you will see that each bottom is above its previous one. This one is above this bottom, this one is above this bottom is above its previous bottom. Similarly, each top is above its previous top. This is above this one above this one above this. Thus, an uptrend has a series of upward moving wave structure. Similarly, an exact opposite is a downtrend. Let's go ahead. Downtrend. A stock is said to be in downtrend or moving downwards if it has falling tops and falling bottoms. A stock in a downtrend keeps making new lows after retracement. It will make a new low, retrace back, cover some of its losses, go up, and finally it will cease going upward and start moving down, thus giving a new top and a new bottom, and went and go ahead to make a new low. Let's take a look at theoretical price structure. This is how an ideal downtrend should look like. Similar and opposite of uptrend is nature of downtrend. Series of downward sloping wave structure or price pattern is characteristics of downtrend. You can see it has a series of falling tops along with a series of falling bottoms. Let's go ahead, take an example of real chart example. This is Madras Cement chart for the year 2013. It covers data from March 2013 to September 2013. You can see this stock shows characteristics of downtrend where it has a series of falling tops along with a series of falling bottoms. Every time market goes lower, breaks its previous bottom, it surges up but fails to sustain its upward momentum, comes down, makes a new low, surges up, fails to break its previous top, comes down, makes a new low, surges up, fails to go any higher, and finally broke down to make a new low. So each low is below its previous low. Similarly, each high above it is below its previous high. You can see each recent high is below its previous high. So this is the characteristics of a downtrend. A series of lower highs along with a series of lower new lows. So what is a sideways market? A market that does not show characteristics of any trend can be categorized as a sideways moving market. A sideways moving market or non-trending market is price structure where no reliable pattern can be traced. The structure of the prices keep changing unreliably. As a result, it becomes difficult to identify any tradable pattern. Let's take a look at an example, a theoretical one first. Sideways moving market or no trend. A market or a stock price is said to be moving sideways if it has no trending pattern, that is, no upward moving wave pattern or downward moving wave pattern. A stock can be said to be in non-trending zone if there is no clearly identifiable wave structure. Take a look at the figure below. You can see there is a series of rising top with a series of rising bottom, but suddenly the series is broken and a new low is made, thus voiding the fact that this stock is in an uptrend. Then you have a couple of rising tops along with a couple of falling bottoms, suggesting the fact that it might be now in a new downtrend. But then a new top is made, voiding the idea that downtrend, avoiding the idea of a downtrend, and then prices go ahead to make a new high. Thus, no reliable price structure can be identified out of this set of data. Thus, you can say no clear price structure can be identified. Let's go ahead and take a real chart example. This is chart of L&T Finance covering data from May 2014 to November 2014. You can see in May it surged higher, came down, went ahead to make a new high, thus suggesting that this stock might be in an uptrend. Then it came down, found support at its previous low, went up but failed to go ahead and make a new high. Rather, it came down and made a new low. Here, it suggested that this stock might be in a downtrend. Went up, failed to take out its previous high, came down, took out its low, thus confirming the fact that this stock is in a downtrend. Surged up, came down, failed to make a new low, turned and made a new high. So your idea of a downtrend is now void. Now it suggests that it might have changed its direction towards up, but comes down, finds support, fails to make a new low, makes a higher low, goes up, fails to make a new high, and falls down, goes ahead to make a new low. Thus, no clear price structure can be identified out of this set of data, telling you that this stock has no clear trend or this stock has no clear tradable trend. As a result, it's better to avoid such charts. Remember, always trade in trending markets. As it is said, trend is your friend. Always look to trade trending markets. Avoid non-trending markets. Big money is often made in trending markets. Even if you go wrong on a couple of your trades in a trending market, one right trade will cover all your losses. One single trade will pay for all your losses. In a trending market, if you try to put your hand in a non-trending market, or since there is no reliable direction in a non-trending market, it's better avoid non-trending markets. People often get big heartburns in non-trending markets. As I have said earlier, technical analyst depends on reliable price patterns to take his trades. Trending patterns are reliable price patterns, whereas non-trending patterns are non-reliable price patterns. Hence, it is better to avoid low volume, non-trending pattern or non-trending market and look to trade in trending markets. Let's go ahead and learn about moving averages or dynamic support and resistance. Moving averages are the most commonly used indicators in technical analysis. You will find them in any charting software, whether paid or free. Moving averages act as an excellent support and resistance zones. Often you will find prices respecting moving averages. In technical analysis, there are many different variations of moving averages, like simple moving average, exponential moving average, weighted moving average, or displaced moving average. Though they differ in name and the calculations, but the manner in which they are interpreted is mostly the same. For our current tutorial, we will mainly focus on simple moving average and exponential moving average, as they are the most widely used indicators. Let's go ahead. I'll give you a brief introduction of what is a moving average, just in case you're not aware of it, and walk you through of how it is calculated. Although we will not go in much depth of calculations, still it's better to have a rough idea. A moving average is average price of a certain number of price bars. Mostly a close of a price bar is used to calculate moving average, but a moving average can be calculated using any price factor like high, low, close, etc. A 20-period simple moving average is calculated by adding close price of recent 20 bars and dividing them by 20. Similarly, a 50-period moving average will be calculated by adding close prices of recent 50 bars, dividing them by 50. Whatever the figure comes, that figure is plotted below the recent bar. Once these figures are plotted over a number of bars, you will see them forming a continuous line. Hence, a moving average looks like a line plotted on a bar chart. Let's go ahead and see what are the common price settings used to calculate moving average. Or what are the most commonly used moving averages? For short-term trades or trades that are no more than 2 or 3 days in length, people most often use 9-period moving averages. For intermediate term trades, people use 20 and 50-period moving averages. 100-day moving average and 200-day moving average are used for long-term or investment trades. Let's go ahead, take a look at an example. Following is an HDFC Bank chart. It's a daily chart covering data from the month of August 2004 to November 2014. The pink colored line is a 20-day moving average of close. Alright, MA stands for simple moving average. If you are plotting an exponential moving average, it will be plotted as EMA, exponential moving average. Similarly, a displaced moving average will be plotted as DMA. No matter what the name, the interpretation is almost similar. Compare this pink colored line with the bars or price chart. You can see that a lot of places prices have found support around these pink colored lines. Here you can see it went up, crossed the pink colored line, came down, found support at pink colored line, went up, 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 came down again, found support, went up, came down, found support, went up, came down, found support, up, down, support, broke to a new high, went sideways, made a new high, reacted down, could not penetrate its 20-day moving average, went up to make a new high, came down, failed to penetrate 20-day average, and then went ahead to make a new high. Thus you can see prices respected the levels of 20-day moving average. 20-day moving average will also help you understand, or they will also help you identify strong trending markets, as 20-day moving average moves very close to price charts or very close to price bars. They will often help you identify strongly trending markets, as is the case of HDFC Bank. Going ahead, this is chart of Hornet stock. This is a stock traded on NSE exchange. The white colored line is a 50-day simple moving average of close. You can see here this simple moving average is plotted as a continuous line. Alright, since it's a 50-day moving average, it is a bit less flexible as compared to a 20-day moving average, as it considers a larger set of data to calculate its own value. Nonetheless, you can see how Hornet has respected the level of 50-day moving average, came down, found support, went up, went sideways, came down, found support, continued to go sideways, made a new high, reacted, came down, but found support at 50 simple average, came down, again found support, and then on this bar finally it made a new high of 5,800, went sideways for 2 weeks or so, and then it's finally broke out to a new high. Thus you can see how this stock found consistent support at its 50-day moving average. Next in line is a chart of HOVS, and we have 100-day simple moving average plotted on it. This white colored line is 100-day simple moving average. MA close 100, which means it's a moving 100-day average of close, plotted as a continuous line. And you can see how prices have found support at its 100-day moving average and went ahead to make a new high. Following is a chart of Industrial Bank, and you can see a lot of colorful lines plotted on this chart. These lines are many different moving averages. We'll go ahead one by one. Gray colored dotted line, which is moving very close with price bars, is 20-day moving average, and you can see it is much more flexible as compared to any other lines plotted on the chart. It is flexible and it reacts more to a price change because it is a 20 EMA, 20-day exponential moving average of close. Alright, hence it is more flexible as it is taking an average of lesser data. The green colored line is 50-day EMA, exponential moving average. It is not as much flexible as 20 EMA. Still, it is much more flexible as compared to this white dotted line. This white dotted line is 100-day simple moving average. Take a look here. This white dotted line is 100-day simple moving average. And you can see since it covers a larger set of data to calculate its value, it is not as flexible as any other moving average. It's not as flexible as 20 or 50-day moving average. Nonetheless, it is much more flexible and closer to price data as compared to a 200-day moving average. A 200-day moving average takes close prices of past 200 days to calculate its value, and then it plots itself on the chart. Hence, it is much slow and much more rigid as compared to any other moving average. Now I've plotted all these moving average to give you a live example of how prices react when they reach levels of any of these moving averages. We'll start from November 2013, and these colorful circles are there to tell you which moving average acted as support or resistance. Pink colored circles suggest that prices found resistance at 200 moving average. White colored circles will suggest that they found support or resistance at 20 EMA. Green color will suggest that prices found support or resistance at their 50 EMA. And this white color shows that prices found support at their 100 simple moving average or MA. Starting from November, you can see prices surged above its 200-day moving average but failed to sustain itself, came down, surged above again, failed, came down, found minor resistance, drifted down, tried to break out again, failed, broke below, went lower, and then it went sideways for the month of Feb. Finally, in March, it broke above its 200-day simple moving average, surged higher, reacted, came down, found support at 20 EMA but could not make a new high, came down, found support at 50 EMA, made a new high, drifted down or started retracing lower, respected the level of 20 EMA, reacted positively, broke down but found support at 50 and changed its direction, came down, found support at 50 again, changed its direction, went sideways, broke below 50 but found support at 100, went up, reacted for a couple of days to find support at 20 EMA, made a new high, started retracing back again, and yet again it found support at 50 and then resumed its upward direction until it retraced back to find support at level of 20 EMA. Thus, moving averages provide you dynamic support and resistance levels. Thus, moving averages help you identify true support and true resistance levels. For example, if you were to follow 50-day moving average, you can see how 50-day moving averages kept on giving you correct support zones or places where you could have revised your stop losses. Hence, it is very important to make moving averages a part of your technical analysis tools along with charts and volume identification. Finally, we'll conclude our current tutorial on basics. In this tutorial, you learned why there is a need for technical analysis and how technical analysis is convenient as compared to fundamental analysis. You learned the qualities of a technical analyst, why never to trade on tips or rumors, and why always to use a stop loss. You learned how to identify trending and non-trending market and which ones are better to trade or which ones are better to be exploited. You learned about support and resistance and where they are likely to be found, moving averages along with the common settings. With these basic knowledge, you are now ready to dive deeper into technical analysis. Remember, the knowledge is basic, but it's still very much powerful, especially identifying trending and non-trending markets. As with every profession, technical analysis too will demand your time and concentration. Practice the basics as much as possible to get familiar with charts, price patterns, tinker around moving averages. You'll find a lot of technical analysis software on internet, paid as well as free. Desktop softwares as well as web versions, with or without data. Try them out. It's always good to first try out free ones or trial versions of softwares that you like. Get familiar with their usage, get used to them, see which one is more convenient to you or suits your type of trading style. Later on, you can buy the one you like. In our next tutorial, I'll teach you configuring a technical analysis software and how to download and import NSE and BSE stocks data into it. Till then, goodbye.